Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the crazy world of corporate finance. And let me tell you, the latest filing from Palisades Venture Inc. is a real eye-opener, a story of a company trying to find its footing in the tech world while battling some serious financial headwinds. All right, let's dive right into the heart of this 10K report from Palisades Venture Inc. This is their annual look back at the year ending December 31, 2024. Now, this is the big one, the annual report that tells us everything about what a company did over the past year, and Palisades Venture Inc. is no exception. First off, a quick look at the company's identity. They are incorporated in Wyoming, and they've got this commission file number that the SEC uses to track them. What's interesting here is their stock is actually not traded on any major exchange. So that means there's no easy way to see what the market thinks of them day to day, making this filing even more crucial for understanding their situation. They are not a well-known seasoned issuer. This is another signal that they're a smaller company, not yet on the radar of most investors, which often means higher risk, but also potentially higher rewards if they can execute their plan. And yes, they have been filing all their reports on time for the past year, which is good to see. They are also actively submitting their financial data electronically, which is standard practice now and helps with transparency. They are a non-accelerated filer and a smaller reporting company. This basically means they don't have to meet the same stringent reporting requirements as the big players, but it also means we have to dig a little deeper to get the full picture. And here's a pretty stark number. The market value of their non-affiliate stock is 0 as of the last reporting period. This is often because the stock isn't publicly traded or has very little activity, but it underscores their current market standing. By August of 2025, they had 109.5 million shares issued and outstanding. This number grew a bit from the previous year, according to the later notes, indicating they might have issued more stock to raise capital or pay for services. Let's get into what this company actually does. They are a data center and computer storage company based in the US. They got started back in 2021 by absorbing the assets of another company called Landmark PMG LLC, which was part of CorpTech Holding Inc. This was done through an asset purchase agreement that involved a significant chunk of their stock and some cash. So their main focus is cloud computing, keeping businesses running during disasters and beefing up their cybersecurity. It's a crowded market, but these are essential services. They talk a lot about their expertise in cloud computing and disaster recovery, mentioning they use top-notch hardware and software from big names like Cisco, Dell, and Microsoft. This suggests they are trying to build a reliable infrastructure. Now, this is a bit unusual. Management expects to use consultants and lawyers, but doesn't anticipate needing any full-time employees. This could mean they're trying to keep overhead super low, or maybe they're a very small operation, relying heavily on external expertise. It also raises questions about who is actually doing the day-to-day work. But like many smaller companies, they're taking advantage of the Jobs Act. This means they get some breathing room with reporting rules like having fewer years of financial data to show and less need to disclose executive compensation details as deeply. Interestingly, they've decided to opt out of the extended transition period for new accounting standards. This means they'll be following the same timeline as bigger companies for accounting rule changes. It's a decision they say is irrevocable. When you're a smaller company in a competitive space, risk factors are super important. However, they're not required to provide them here because they are a smaller reporting company. This means they don't have to detail the risks they face, which is a bit of a blind spot for us trying to assess their future. Under cybersecurity, they're quite direct. They state they do not have the manpower expertise or financial resources to effectively manage cybersecurity risks. They add that no assurance can be given that they won't be damaged by exploitation of their vulnerabilities. This is a pretty blunt admission and a major red flag in today's digital world. While they didn't identify any specific threats that caused material problems last year, they also admit they might not be aware of all vulnerabilities. It's sort of like saying, we haven't been robbed yet, but we don't have strong locks either. Here's a really simple statement. We currently do not own or rent any property. This further emphasizes their lean operational model, perhaps relying on cloud infrastructure, which doesn't require physical office space. Management is not aware of any legal proceedings concerning the company. This is generally good news, meaning no major lawsuits are currently weighing them down. Back to the stock situation, it's not listed anywhere, so no trading figures to report. As of December 31, 2024, they stated no shares of their common stock had been traded. They had 100 million shares issued and outstanding at the end of 2024. This number grows later in the filing, so we'll keep an eye on that. No dividends have been paid. This is typical for early stage companies that are reinvesting all profits or more likely not generating profits to distribute. Not applicable here. This section is usually for companies with a longer operating history, which Palisades Venture Inc. doesn't have yet. This is where management tries to explain their performance. They start by warning that their future projections include risks and uncertainties. Now, for the numbers that really tell a story, their cash balance at the end of 2024 was a minuscule 1,103. They explicitly state this cash balance is not sufficient to fund their limited operations for any period of time. They've been relying on their chairman for funds, but he has no obligation to keep doing so. This is a precarious position they're in. They're dependent on someone's goodwill for survival. And here it is, the dreaded going concern opinion from their auditors. This means the auditors have serious doubts about whether the company can continue operating for the next 12 months unless they get more money. They have accumulated losses of over $438,000, have very little working capital, and were burning cash in operations. These are tough signs for any business. Let's look at revenue. Revenue for 2024 was about $179,000, up from about $147,000 in 2023. The increase is attributed to more IT consulting work. The cost of goods sold increased slightly, mainly for server system maintenance. However, their general and administrative expenses nearly doubled from around $64,000 in 2023 to over $115,000 in 2024. This jump is blamed on higher legal professional and audit fees, which is common for companies preparing these kinds of reports, but still a significant increase on their revenue base. And what's the bottom line? They had a net loss of almost $10,000 in 2024, down from a profit of about $12,000 in 2023. So a swing from a small profit to a loss. Their plan for the future is to keep borrowing from related parties, which, as we saw, is not a guaranteed source of funds. They don't have any off-balance sheet arrangements, which is a good thing to note. It means there are no hidden obligations lurking around. They also have no material commitments. This suggests they aren't tied into any large future obligations with suppliers or partners. And they don't plan to buy any major equipment, which is understandable given their financial situation. This section touches again on the going concern issue. They have a retained deficit of over $438,000 and very low working capital. They acknowledge the real possibility of not being able to continue operations without more funding. Looking at cash flow from operations, they used about $12,000 in 2024, compared to generating about $43,000 in 2023. So another reversal from positive cash flow from operations to using cash. A quick update here, they now have over 109 million shares outstanding. This is up from the 100 million reported earlier, and likely due to those consultant share issuances mentioned in the subsequent events. This section is just a table of contents for the actual financial statements, which are the core of any report. Here we see the report from their auditors, Raj Gupta and Co. You'll notice they were issued an unqualified opinion, but with a significant going concern paragraph. The auditors mention critical policies like revenue recognition and going concern itself. This tells us these are the areas where management's judgment is most heavily relied upon and where there's the most uncertainty. They mentioned that any uncorrected misstatements were clearly trivial and that management agreed with any identified misstatements which were then corrected. This suggests the auditors and management are aligned on applying accounting principles, though the sheer volume of potential issues for a small company can be a concern. The auditors confirmed that Note 3 to the financial statements details all matters relevant to the company's ability to continue as a going concern, including significant conditions and events and management plans. This means all the warnings about their financial health are formally documented and flagged. Let's dive into the balance sheet. This is like a snapshot of what the company owns and owes on a specific date. Looking at assets, cash was just $1,130 at the end of 2024, down from $4,207 as a year earlier. This is alarmingly low. They had about $10,615 in receivables. This is money customers owe them. So total current assets are just over $11,000. That's not a lot of readily available money. On the liability side, accrued interest was around $11,867 for 2024. This is the interest that's built up on their debts. They had a negative related party payable of $337,000 in 2024, down from over $37,000 in 2023. This negative amount usually means the related party owes the company, which is a good sign here, not a liability. Their long-term note payable to a related party stood firm at $300,000. This is a significant chunk of their debt. They also have a convertible note payable of $39,000. This is a loan that can be converted into shares of stock. Common stock is recorded at par value of $100,000 for 100 million shares. The accumulated deficit, a running total of losses, stands at over $438,000. This shows they've lost more money than they've made since their inception. Total liabilities are around $350,000, which combined with their deficit leaves them in a tough spot. Now let's look at the income statement, the P&L. This shows how much money they made and spent over the year. Revenue for 2024 was $178,962, up from $147,195 in 2023. That's a roughly 22% increase in revenue. Cost of sales was $41,000 in 2024, up from roughly $39,600 in 2023. Gross profit revenue minus the cost of sales was $137 in 2024, a decent increase from $107,483. Operating expenses were $115,755 versus $63,985 versus a big jump of about 81% in operating expenses. And the net result, a net loss of $9,910 in 2024 compared to a net income of $12,161 in 2023. So they moved from a small profit to a small loss while revenue grew. Earnings per share is 0 for both years, which is typical when a company is small and has many shares outstanding. This statement shows how the equity section of the balance sheet changed. It tracks common shares outstanding, which are stable at 100 million for these 2 years. The paid-in capital started negative at a deficit of almost $57,000 in 2022. It improved but was still negative around $28,000 in 2023, and then a tiny positive $42 in 2024. This reflects the issuance and valuation of stock. The accumulated deficit shows the net losses over time. It grew from over $413,000 in 2022 to over $420,000 in 2023, and then to over $430 in 2024. The cash flow statement is crucial for understanding how cash is moving in and out of the company. It starts with the net loss of $9,910 from operations. Then it adds back imputed interest of $28,500 to reconcile to cash flow. Imputed interest is a non-cash expense that represents interest on a loan that doesn't formally charge interest or charges below market rate. It's important for accounting but doesn't reflect actual cash outlay. Overall net cash used in operating activities was $12,324. They used cash here, which is not ideal. In financing activities, they had related party advances of negative $37,930 in 2024, meaning they repaid more cash to related parties than they received. They had debt borrowings of $22,500 in 2024. Net cash used in financing activities was $15,430 in 2024, so they used cash to manage their financing. The net change in cash for 2024 was a decrease of $3,104, bringing their cash balance down to that very small 1,130 figure. The notes to the financial statements provide important context. They reiterate the acquisition of 4Service Cloud Tech from CorpTech Holding Inc. in 2021. This is key information. Ori Rechtman, the CEO, owns nearly 69% of the company, and CorpTech Holding owns about 23%. This concentration of ownership is significant. Under significant accounting policies, they detail their revenue recognition, which follows standard accounting principles. They have an allowance for doubtful receivables. However, they state the allowance is 0 because they believe all receivables are fully collectible. For a company with such low cash levels and uncertain future, believing all receivables are collectible might be optimistic. They account for stock-based compensation according to accounting standards, but note they haven't issued any stock awards to employees in their named executive compensation table later on. They explain how they value financial instruments using a fair value hierarchy. This is standard procedure, but given their small scale, it's likely they use simpler level 1 or level 2 inputs. They have net operating loss carry forwards of over $333,000 as of December 31, 2024. These can be used to offset future taxable income, but since they are currently not profitable and have a valuation allowance of 100% on deferred tax assets, it's unlikely they'll benefit from these soon. This is where the auditors and management again emphasize the going concern issue. They have losses, low working capital, and negative cash flow from operations. The reliance on related party funding is highlighted as a critical point for their survival. This note details transactions with related parties, specifically Ori Rechtman, the CEO, and Corptech Holding Inc. The amounts due to Mr. Rechtman have changed significantly. In 2023, they owed him over $37,000, and in 2024, they owe him nothing, but he owes them a small amount. This could indicate a repayment or a shift in how funds are advanced. These loans from Mr. Rechtman have no formal terms, which is a common practice in closely held companies, but adds to the uncertainty. This confirms the interconnectedness. Mr. Rechtman is the CEO of Palisades and owns a majority stake. He also owns most of Corptech Holding, which is a significant shareholder in Palisades. These intertwined relationships can offer flexibility, but also create potential conflicts of interest. They have a $300,000 note from Corptech with a very low interest rate of 0.5%. However, they impute interest at a much higher rate of 9.5%. This imputation is a significant non-cash charge that impacts their reported losses. For 2024, imputed interest was again $28,500. They also have a service agreement with Corptech paying them $2,500 a month for services. In 2024, they paid $30,000 for this service. This note details a convertible note from Robert Papiri for $24,000 with an 8% interest rate. It was revised in 2023 and can convert into 2,500,000 shares of common stock. In June 2025, more shares were issued to consultants, bringing the total outstanding to 109.5 million. This dilutes existing shareholders. Concentration of major customers is a big concern. In 2024, 4 customers accounted for 100% of their accounts receivable. And about 70% of their revenue came from just 3 customers in both 2024 and 2023, with customer A alone providing 32% of revenue in 2024. This high customer concentration is a significant risk. If any of these major customers leave the company, it could suffer a massive revenue drop. They also have concentration of supplier risk. One vendor accounted for 97% of purchases in both 2024 and 2023. This means they are heavily reliant on a single supplier for their operations, which could lead to supply chain disruptions. There's a mention of a compensation agreement in January 2025 for their CEO, Mr. Rechtman, for $12,000 monthly salary. If they can't pay it, it becomes a loan at 5% interest. This is another instance of related party financial arrangements. Under controls and procedures, management admits their disclosure controls are ineffective. They also pointed out material weaknesses in their internal controls over financial reporting. This includes a lack of segregation of duties, no audit committee or independent directors, and poorly documented procedures for evaluating internal controls. Basically, the internal checks and balances are weak or non-existent. Ori Rechtman is the sole director and the CEO. He's been in the tech industry for a long time and has a deep history with the companies that form Palisades Venture. His background is extensive, covering military service, business education, and a long career in technology leadership. They don't have any board committees like audit or compensation. The entire board, which is just Mr. Rechtman, handles these functions. They also state no member qualifies as an audit committee financial expert. This lack of independent oversight is a significant governance risk. Looking at executive compensation, Ori Rechtman received no salary or bonus in 2024. He did have an owner draw of about $25,000 in 2023, which is essentially taking money from the company for personal use. As of the end of 2024, there are no outstanding equity awards for the named executive officer. This table reconfirms that Ori Rekman beneficially owns 75 million shares of common stock out of 100 million outstanding at that reporting date. That's a massive 75% ownership stake. For audit fees, they spent $21,000 in 2024 and only $2,500 in 2023. This increase likely reflects the effort required for this filing and to address the going concern issues. They had no tax services from their accountant. This is simply a list of all the attached documents that support the report, like certifications and XBRL data, tabbed to Palisades Venture Inc. What we're seeing here is a company operating on extremely thin margins with very concerning cash levels and a clear going concern warning from their auditors. Their revenue is growing, but it's not enough to cover their operating expenses, which jumped significantly in 2024. The heavy reliance on a single CEO and related party transactions for funding are major risks. The lack of independent board members and basic internal controls is another serious red flag this company needs to address if it wants to achieve any kind of stability. The heavy customer and supplier concentration is also a significant vulnerability. Losing even one of their few major customers could be devastating given their razor-thin revenue base. Their future hinges entirely on their ability to secure more funding and, perhaps more importantly, to establish a more robust operational and governance framework. Without these changes, the going concern opinion is a very real threat to their existence. What are your thoughts on Palisades Venture Inc.'s situation? Do you think they can turn it around, or are the risks too high? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more deep dives into company filings. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you in the next one.